Good morning, market users, and good morning, traders. Welcome back to another episode of Market in the Morning, a special edition episode. And that's because today we have some big economic data coming out that could really move markets if we get the right catalyst. Now, we have PCE and we have GDP. Now, hopefully, we get some consistent readings because at this moment, the Fed is still hawkish. We haven't seen any consistency. Gold has been very range bound, and we really need to find a reason to break. So, guys, hit that like and subscribe button if you're ready for Market in the Morning because the show starts right now. Yo, Nilabh, good morning.
What's up, man?
Dude,
Happy
good morning.
Friday. Thank God it's Friday.
Yo, you're telling me this week
It's been a
felt like 2
long
weeks.
week, huh? Felt like a
Yes,
long
sir.
week, especially with slow markets. Man, these weeks just go by way slower than any other high volatility week.
Yeah. No, seriously, man. I know. It's like we get good ranges, we get good moves, and then this week it felt like a sloth was controlling the market.
Yeah, it's a bit weird, right? Being so conditioned to like intense volatility for the past 3 months, and then a week where we're ranging in a tight range, you're just like, fuck my life. You're like, this is horrible.
Yep. You know, it's funny though. I always like to think like the market needs these weeks in order to knock out all those traders that fail early and give up quick, right?
Yeah,
Because there's got to be
exactly.
that exit liquidity in a sense. There's got to be that reason that people don't stick around. And it's going to happen, right? Market conditions are always changing. We just got to stay strong with it,
Oh yeah.
not risk too much, and keep trading what we know.
Yeah, markets like eat up people during these times. So it's
Yeah.
good that if you're saving your capital, saving it for a better day, a rainy day, not a rainy day, but a better day, then you're gonna have more chances of staying in the game longer.
Yep. Absolutely. Yo, I'm going to pull up your chart. Let's see what's
Let's
going on
go,
with
man. Let's go
markets.
right into. We got about 7 minutes before this set of data comes out. But before we even go into that, let's just quickly look at some headlines that we have here. So, like gold dips to 50.32 amid U.S.-Iran tensions. GDP PCE data looms large. Right. We go to ES. Same thing. Dips. Dip buyers. PCE GDP waiting. Right. Iran tension. You can see that that is the overall arching theme across all global markets, Iran tensions, PCE, right? Anywhere we check this out, this will be the same catalysts that are impacting global markets. And that's why I want to bring this out. It doesn't matter what asset class you trade, whether you trade crypto, whether you trade currencies, commodities, right? Whether you trade equities, options, right? Futures, index futures, like everything is impacted by the same handful of catalysts that are happening and across markets, right? So if I look at gold in this case, geopolitical premium from US Iran escalation. And we know what's coming. We know in the next few weeks, things are going to get a bit more intense. Unless Iran works out a nuclear deal, which do you think that's going to happen? That's a low probability.
Yeah.
Fed rate cut expectations declining. So it's like central bank buying structure, right? So it's the same type of things that are holding the weight. And which makes it great for us because if we go to the high impact section, we can quickly see where all the things that Trump was saying regarding Iran. Like here's some Iran headlines as well. Military aggression, Iran will respond, and all bases, facilities, and assets of hostile forces in region will be legitimate targets. This was 14 hours ago. So this was when the new yesterday's daily candle closed. We had some Fed headlines in the middle, like Fed's daily. She was saying expect inflation to come down as tariffs roll off. Labor market is more subdued than before, so we don't see inflation coming from AI capex, right? But the main thing being really bad things will happen if no Iran deal. Like, look at this. Look at this headline. This is a headline that is instigating and putting fuel on the fire that already exists. We'll get a deal on Iran one way or another. We'll get a deal again, right? So it's like the same things being repeated. And we know what this means. Usually, when we get these types of headlines, what happens on a weekend? Random bombings. You wake up on a Saturday morning ready to make your coffee, and you're like, well, Trump just bombed the Middle East. And now you're like, I'm instantly, I know this is a bit messed up, guys. Don't blame me. I'm just a day trader. Instantly, I'm like, I wonder where gold will gap up. That is
wrong?
I'm an honest guy. That is the first thought in my head is when I see something like that, let me check market, see what headlines came out and where gold could gap up, right? So we're still very bullish on gold, right? Because of these tensions. We're still bullish on ES or in the higher time frame in US equities, but it's just this back and forth geopolitical risk premiums, right? Easing of Fed rate cut bets, adding to more Fed rate cut bets that were caught up in this range bound over here. This is the same range that we were in when Venezuela invasion was happening, right? So you can see that instability from the geopolitical tension that causes a bit of outflows from US equities. But as soon as those rate cut bets come back on the table, we get more bullish pressure. And then when they get taken off, we're back range bound. So we're still in this range. However, we are higher time frame bullish on ES. Right, we got 4 minutes before this data, so let's quickly break it down and what this means. So we have a handful of data. We're going to be paying attention to PCE price index, specifically the year-over-year headline reading, which is this one here. So if I click this, markets are expecting a 2.8% over here. Let me, if I zoom in a bit, there you go. Markets are expecting a 2.8%, same with the bank forecast. Previous was also 2.8, with a minimum range being 2.6, maximum being 2.9. So if I click this brain icon, I can see that if we come out higher than expected, that means we're bullish. And the reason that means we're bullish is because inflation remains sticky and Fed rate cut bets get pushed back. And exactly as how Kevin was saying, the Fed is more neutral to hawkish currently. Keep that in mind. Yes, we have a more easing policy in forward guidance, but the Fed is still more hawkish currently because they have been pushing back on rate cut bets. As well as you can see, the rate cut probabilities are still mainly eyeing June as the cut, right?
Yeah.
March, April are just write-offs. Like they're just straight, no change, right? So higher inflation brings that outflow on gold. I know what you guys are thinking, that, oh, Nilabh, inflation is a hedge. Sorry, gold is a hedge for inflation. Why would gold go down if inflation goes up? Guys, it's all because of how it impacts monetary policy and forward guidance. Let go of your regular understanding of economics and pay attention to what Papa Nilabh is telling you right now. Because I'm telling you, like, if you're paying attention, you're going to understand how to trade these data reports properly. So if we come out below 2.8, we're going to get a bearish dollar. And if we get a bearish dollar, we're going to get a bullish gold. Why are we going to get a bullish gold? Because lower inflation brings those rate cut probabilities higher. Markets are going to anticipate more rate cuts sooner, right? Currently, they pushed it back. So that's what we'll be waiting for. We also have GDP data, right? So we have GDP down here, a ton of data this morning that we're going to have to watch and see how it comes out. If it comes out mixed, we're going to, honestly, we might have to stay on our hands today. If it's one-sided data, we can then look to see how markets digest these data reports and then plan out some pre-planned trade ideas, and hopefully we can execute on them. But in all honesty, I think this might be a bit of a day where we kind of sit on our hands if it comes out mixed. If we do get breaks on gold above 50-40s, and we get lower inflation data, then boom, that's easy buys. You're riding those easy buys into 50-80, 50-90, 50-100 on gold, right? And same with ES. Lower inflation data will just continue to push ES back to like 6,900, these intraday highs that we created on Wednesday, but we weren't able to get back above. And if you remember, this is the exact same setup that we called out, that Kevin called out a few days ago when we were talking about our TP right at 6,900. We peaked a bit higher, and since then been a bit more range bound. So here's this data in about 17 seconds. And over here, I'm just going to open up dollar.
I'd like to see, guys, we have to see some extremes with the data. If we don't get an extreme, we're probably going to stay within this range and still be considered mixed. Hopefully we do get some type of cooling on inflation. You know, GDP, ooh, 1.4.
GDP advance came at 1. Oh, inflation went up. We went from 2.8 to 2.9 on the year-over-year PCE reading. So when we click this brain icon, we can see if we're at 2.9, we're going to get a bullish dollar, right? We're not above 2.9, but we are above the 2.85, right? So we're going to get that bullish dollar here, because what this means is that rate cut bets are going to continue to get pushed back further. Now, if I open up dollar, zero impact so far besides this quick liquidity move, right? Even gold, absolutely nothing in the market. So let's continue to monitor this. Gold, higher inflation, meaning we should get some sort of outflow, right? Whether it be a small little move, but this looks like the most uneventful fireworks I've ever seen. This looks like if somebody lit off the fireworks and then nothing happened, and you have a crowd of 1,000 people just sitting on their hands, right? That's exactly that. That's what I meant. It might not have been the most ideal day because of the amount of data that we have, right?
Yeah.
1.4 for GDP. Previous
That
forecast is 3%. Like this is so this is
that's
what I mean. Even
insane.
core PCE also year-over-year reading also went up to 3% versus a previous of 2.8 and forecasting 2.9. So it's persistent inflation data. Let's check out the headlines over here and see what came out, whether any rate cut bets got triggered or pushed back. Sorry,
Well, yeah,
those will
there's a
start to come in. But this is what I mean. It's a very, since we knew that CPI had come out softer, we were pricing that in. Yeah, exactly. Mixed data like this requires way more patience, and this is what people kind of neglect, is that they see inflation data, they're like, oh, it came out higher. Now I'm going to take a trade. It's like, no, you have to understand that this is what the Fed looks at, right? Fed loves PCE. Okay. But the markets only care about CPI. If you go back to every PCE release versus CPI release, you will see the markets only give a shit about CPI, right? So CPI, we know already is softer. CPI is on its way down. You also have Fed Daily telling you that CPI is on its way down. So it's something like this, one odd data report that pushes up doesn't have as much of an impact as, let's say, CPI pushing up 0.2%. That's going to hold greater impact because that's what the markets are focused on, right? So not seeing much movement across. The only thing we're seeing is that gold bear pushing down, maybe even down to like 5,000. And then we might actually see buyers jump back in, just because I think this move will eventually get faded out. But we are seeing those gold bears, right, come in. And there's those dollar bulls that we talked about as well, because the data came out higher than expected, right? Still within the range. If I click this brain icon, excuse me.
Bless.
If I click this brain icon, you can see we're above this 2.8 reading. So we're going to get that bullish dollar. And that's what we're getting right now, right? We're getting that in the short term. We're getting this bullish dollar with potentials to head back up to 98.05.
Yeah, this mixed data is definitely making it harder for markets to try to find a range here. I would still consider this a range. I like the level Nilabh mentioned about the 5,000 being a pullback area. I would want to really see support on gold at some point. So I would like to see this as more of a buy the dip opportunity, especially
Yeah, I
right.
agree with you. I
No, you're
agree with
good.
you. To buy the dip opportunity is just, it gets a bit messy in here. Is that if
Yeah.
somehow we were able to come to 5,000, create some sort of lower time frame support, sick. You could ride those short term buys up to 50, 40, right? Get your $40 worth of move, whatever position size you're using. The other place I would look for is this 49.60s area that we held throughout this entire week, right? After we bottomed out here, since Wednesday, we've just held on to this price handle right here. So this is another pullback area I would be looking out for. The only reason is I would be a bit hesitant to be taking buys, given not too many confirmed, is the fact that we got a bit of mixed data, but at the same time, like, it is end of the week. We've had low volume volatility the entire week. If you weren't positioned in gold buys from here, trying to enter here, will mess with your mind, because you don't know what the market's going to do on a Friday. The last thing you want is to be buying here, then instantly you see a dip down to here, and now you're like, fuck, I just gave up Wednesday and Thursday's money. Right? That's not what you want to do. You want to remain vigilant. You want to remain smart. You want to understand how money's actually flowing. And money's currently flowing into the dollar. So if money continues flowing into the dollar, this 5,000 price handle may not hold. So this is why I talk about you shouldn't be reactive, right? You need to be more proactive. You need to understand how price is reacting, why it's reacting here. You have to take into account market psychology. What are the institutions, what are the market makers really doing at this level, right? So all of these are very, very, it all comes together. When somebody asks me, how long will it take for me to get profitable at day trading? First thing I tell them, it took me 4 years to make a dime in the markets, right? I've been in the game for 8 to 9 years now. So it took me a while to make a dime, right? Second thing is, you'll go through so much stress in trying to piece things together, is that it's going to take years off your lifetime. So after all that, you'll probably make $1,000 in your first year of day trading, right? But But then we came out with market, and if you are more of a newbie trader, now you can come together and things are pieced together for you. So you know that dollar is going to see bulls when we get higher inflation data. When we don't get higher inflation data, then we're going to see outflows from dollar, right?
Yep. Yeah. Yeah,
So
that GDP miss was huge, man.
that was a
That
it was a
was
fat miss, especially because it was also this was also the advanced reading, right? So we
yep,
still have like the
the
actual
full.
reading, which is going to be like I think a month down the line, which will
Yep.
be so we'll see how that comes out. But again, same thing as how CPI holds more impact than PCE. The advanced readings of GDP of even PMI hold more than the final readings do, right? Because it is the first number that hits, and this 1.4 can hits. Although it's bad, like it's still this PCE data is holding more weight, as we can see. Like dollar bulls are just continuing, right?
Yep.
Gold is a bit more choppier. I would like to see. I hate this price action on gold. I'm not a fan of it. But we did reach the target we were talking about last time of 50.40. You can see we had exact reactions at 50.42. We saw outflows of $40. And then since then, we are still maintaining this overall large bullish structure that market has been reacting to.
Yep. Absolutely. It still has been like Nilabh mentioned. I'm going to share my screen for a quick moment on gold.
Absolutely.
Somebody's asking also, they're saying, shouldn't gold be bullish by the news? Yeah, so exactly. Sort of like I mentioned before, how it's possible by the dip opportunity, right? But we don't want to be breakout traders at this point. Something I wanted to point out.
Yeah, go ahead. I have something
gonna
to add on to that comment.
Yeah, no, 100%. So on gold, I'm just look right here, Wednesday, right? So Wednesday, if you took breakout trades from this Monday, boom, you took a breakout, it faded. The following day, what happened? You take another breakout, it got faded. Following day, from that same high, faded. So it's still trying to make these higher highs, even over here. You take that, breakout, maybe you would have got a few points out of it, but where do you know your take profit is, right? You would have pulled back, stopped out. So at this point, I would be looking for gold to try to move higher. I would want to see a buy the dip opportunity here, but I'd really be a bit more interested in taking the shorts off of that if we don't have good volume on the breakout. We are making some higher lows though. Look at this. We haven't taken out that low, haven't taken out that low. Haven't taken out that. And again, those fundamentals, that GDP, so US GDP advance plus 1.4% significantly misses of 0.3%, signaling a sharp economic slowdown than anticipated, likely due to the government shutdown effects and weakening consumer spending. So again, this would prompt up gold.
So this would prompt up gold, but the PCE data prompts gold down. Like that's what we need to keep in mind. That higher inflation data in this case does not mean gold bulls. And the reason higher inflation data doesn't mean gold bulls is because it takes away from rate cut probabilities. I know I say this a lot, but people need to get this in their head, is that when inflation is higher, the chances of rate cuts happening get pushed back heavily. If inflation is lower, rate cut bets come more back on the table, and then you see risk assets flying, then you see gold flying, then you see BTC flying, right? But Kevin is right. The GDP prompts gold up, the release of the GDP being such a miss, but the PCE data also adds to gold pushing down. So that's why you're seeing a bit more of consolidation. You saw a bit more whipsaw, and it's not the cleanest form of data.
Yep, exactly.
Obsessed with Market AI since it launched, started using platform lately. Thanks for doing a great job and easing day traders' burden, guys. I appreciate that. Thank you so much for your kind words. First of all, thank you for being a supporter, trying the platform. We're very, very glad that you're finding use out of it. We have so many more things coming lined up. And Kevin knows it best. Like, we have so much stuff that you guys are going to absolutely love. Like, there's going to come a point where you're going to decide as a user, would I even need TradingView, or can I just do everything I need on market? And that's what we're going for, guys, is that we're going for a complete takeover. We're not going to be a charting platform, but we're definitely bringing something very innovative constantly, and we're pushing the boundaries like no one else.
Yes, sir. I lost you there on that second half, but yes, sir.
Oh yeah, I think I'm lagging a bit.
Oh no.
No worries, but yeah, see, this is what I mean. Dollar's still pushing up, and to the average trader, when you see inflation come out higher than expected, you're like, oh, this means that's bad for the dollar, right? Dollar's losing its strength. That's what it means, but it doesn't, guys. It means it's good for the dollar because we see more demand rush into it since the rates are going to remain higher for longer. This is, I know it may seem a bit backwards, but this is how markets work. Markets are always forward looking. And this is why when Jerome Powell talks about July or June rate cuts, you see markets already running off with it. You see ES reaching 7,000 plus. Why does that happen? Because markets are forward looking. If you know the simple phrase, Kevin, buy the rumor, sell the news, right? You've
There
heard
you
of
go.
that. All that
Yep.
means it's the concept of pricing in. If I'm the chair of the Federal Reserve and I tell you, hey guys, wink wink, I'm gonna cut rates in July, why the fuck wouldn't I start buying the stock market right now? That's what it is. Buy the rumor, sell
Right.
the news, right? It's greed. It's human greed coming into play in the markets where people are like, hey, why would we wait when we can start? We know what's going to happen. Let's just start the rally now.
Yep. Yep.
So it's
Exactly.
the
The
exact
optimism.
same principle. So don't get it backwards where you see inflation go up and you're expecting gold to go up. No, you have to take the data report, any data report that comes in, ask yourself, close your eyes and vision this for me. Look at the rate cut probabilities chart and imagine how it's going to change, right? If inflation
Yep.
comes out higher than expected, that rate cut probability is going to go low. And now you
Yeah.
know, okay, we're not going to get that rally in gold, in ES. But if shit starts breaking, unemployment rate skyrockets, inflation goes down, we're going to get those rate cuts, baby. And gold's going to go flying. ES is going to go flying. People, we're going to make money. So
Yeah.
it's about understanding how things impact monetary policy expectations. The world runs off monetary policy. Hundreds of years ago, the Rothschild family decided to install central banks, and now we're all dependent on monetary policy and how we can forecast and use it to our advantage. Me personally, I love it because it gives us day traders the opportunity to make money whenever the fuck we want after we understand what's actually happening in the market. We need a detailed video for pricing in concept by Nilabh in the channel. Actually, my co-founder has a really good video on this. If you look it up on Capital Hungry YouTube channel, pricing in concept, fantastic video where he goes, and that's where I learned a lot of my knowledge, and of course through trial and error as well. But it's the same concept as, and let me take you back because we don't have a lot of volume and volatility in this session. And you can see how accurate we were about the ES outflows as well, given higher inflation data. Like no one else can call it to this like this, guys. The fact that we called all these ideas before, but second that, I'm not gonna go boost my own bells. But over here, I want to take you guys back to a very, very important time right over here. Majority of you probably weren't trading the financial markets in this area. And the reason I picked this is very interesting. Right here is COVID. This is prime COVID. March 20th is when the Federal Reserve jumped in and they said we're starting quantitative easing. We're cutting rates down to near 0% and we're going to start buying $80 billion worth of mortgage-backed securities and $40 billion worth of US Treasuries every single month to prop up the US economy and keep the markets healthy. That's what they started doing. So for entire months, we saw excess volatility and gold absolutely go ballistic parabolic from 1400 up to 2070. And this was because at the same time, the dollar was being heavily devalued, right? This is the same thing, same time right here. Dollar becomes heavily devalued, and you see gold continue to increase due to that exact same move. And then we went into a period where the Fed says, hey guys, we're going to now hold rates near that. So gold started ranging for a year or two. And then over here, you see what happens. Russia invades Ukraine. You get that geopolitical risk premium, gold shoots up. And then what the markets become focused on next are rate hikes. Remember, we went from a cutting cycle to now a hiking cycle where inflation had just gone up to, what was it, like 6.9%, 7%. Remember that? And
It's
then the
crazy.
market started pricing in rate hikes. But we didn't get the first rate hike until May, right here. But you can see how the market had already topped off. We'd already started selling off, and we didn't get the first rate hike until May 2022. So about massive push down over the course of weeks before the market started pricing. And then we started pricing in more rate hikes to come, and gold went completely down, right? And then after rates were hiked, inflation started calming down. What did the markets do? Markets started pricing in rate cuts and a more easing monetary policy, because markets are always forward looking. And now you got this massive parabolic move towards the upside. And now, Kevin, what are the markets pricing in again? What are they pricing in currently?
Bro, they're pricing in, I don't even know. They're pricing in, are we hawkish, dovish? What
Yeah, right.
happened in midterms? I mean, we got to remember too, midterms are this year. And historically, those are some of the hardest market conditions in general. So we have to be careful with that. You would think that, oh, Trump has got a great pull. We saw that when he tweeted out, now is a great time to buy in April. It, in fact, was a great time to buy. Is he by chance going to pull something out of his hat and do something like that again, so that he could during midterms go, oh, look at the stock market again. Now the Dow is at 55,000.
Yeah, exactly. And all these presidents, all they want to do is look the best in the public.
Yeah.
Right. That's all Trump cares about. All of them come in saying the same lies. I'm not going to start any wars. I'm not going to do this. And then it's the same playbook with every single president. This is why you have to have a less of an emotional attachment to politics and really take their words as a grain of salt, right? Obama said a bunch of things he didn't do. Trump said 10 times the things he didn't do, right? It's like all of them just speak out of their ass, but all we should care about is removing that emotional aspect from politics and understanding how things impact financial markets. I don't care about what Karen is telling me about Donald Trump if Donald Trump is making me $10,000 a week. I don't give a shit. Like, I'm sorry, Karen, that you're emotionally attached. I'm here to make money. I'm not as attached as you are emotionally to politics, because whatever we do, it's not going to impact the overall world. Like, it's just not. Sorry to burst your bubble. Your vote isn't going to stop a war in Iran. Like, it's inevitable. The military-industrial complex is one of the most profitable businesses ever built. You think they're going to stop because some Karen or some girl went protesting in the streets and posted on her social media that, hey, we shouldn't do a war? No. Come on, don't be delusional, right? So just focus on what it actually means for the markets. That if we see some tensions over the weekend, this might be an opportunity for you to buy some gold before market closes, if you want to take that risk, But just know that if something happens, then market open Sunday, we're going to see that bullish momentum carry out.
Right. That's a great point. Nilabh, you are definitely lagging there. Lost in the second half. But anyways, I want to add on to what Nilabh was saying, because that's spot on with the whole don't get emotional to it, right? Don't get attached to it. We're spectators in the grand scheme of things especially when it comes to trading. So if we know that, okay, he's claiming to put new headlines or new tariffs on somebody, I know he's going to pull back on it in a few days. That shouldn't affect the market, because I know that. No, it doesn't matter what you know. The market's going to react to the headline. The markets don't have emotions. They are pricing in whatever the headline brings.
Exactly. And even and a lot of the times you'll see these attacks happen on the weekend when the market is closed, right? And it's to dampen the impact as well. Imagine if it's a regular Wednesday at 6 p.m. Eastern, you see a massive missile hit Iran. Do you understand the amount of market movement that would happen across global asset classes? That's why it's done on the weekend, to subdue and dampen the impact across global markets.
Yeah, exactly. Nilabh, do you mind? Oh, yeah, bro. I don't know. You're glitching out, man. I don't want you to think I'm covering over you or interrupting or anything, but it is like cutting out like
maybe I'll turn off my video. Can you hear me better?
Oh, that's funny. It did come in a lot smoother. It's right. It's like on and off.
Yes. What is happening with indices? So we've been explaining this from the start of this live stream. So if you joined a bit later, here's another explanation. Okay. So you get inflation coming out higher than expected at 2.8, 2.9%. It came out 0.1% higher. When that happens, this means it is bullish for the dollar because you get a monetary policy expectations for higher rates for longer. And when markets are pricing that in, you are going to see outflows in US equities because US equities perform well in a low rate environment because they are risk assets, right? They don't perform well in a higher rate environment, which is exactly why over here, which is exactly why in this portion here, you saw massive outflows all the way from 5,600 down to 4,100. This is here because markets were pricing in a hawkish monetary policy, right? We are in a different macro regime currently, but this data report is doing the exact same thing as pricing in higher rates for longer. So it puts pressure on overall equities. That's why you see outflows come from 68.77 when PCE data came out, as well as for US equities, we also had bad GDP data, which was also putting weight, as Kevin mentioned, on US equities. And this was outside the expected range. Like the markets were forecasting a minimum of 1.5%, right? Keep that in mind. They're already forecasting this massive range, these swing ranges, and we got even lower than that. So outside expected range, higher volatility likely, right? So on ES, it lines up for those outflows, but we are still bullish, right? We're still bullish on ES. As long as we're above 6,800, we're bullish, or even this price handle down here. So keep that in mind. But that's what's happening on US equities, right?
Boom, there we go, guys. Great coverage. You guys, let me know if you have any questions on anything. Nilabh, if you want to turn your camera back on, it's so weird. It started working a lot smoother when you turned
I
it
think
off.
it may have been the camera,
Yeah?
but no worries. We'll keep it on.
Awesome, bro. Awesome. Something I just want to cover ES real quick. We had some comments in the questions. People were asking me to share my screen. So on top of everything Nilabh said, I'm not going to repeat it because I couldn't have said it better myself. That's where we are with equities. That's why we're seeing some weakness right now. End of story. And that's exactly what I was talking about before we even got the news, is I was looking for a catalyst, right? We were looking for an extreme move. We did not want something within the forecast. We wanted something extreme. That GDP advance was extreme. PCE showing inflation's extending, not the most extreme. It's still within the range we were looking at. Where are we? 2.9.
Right there, yeah.
It's towards the max. So again, these are things that could be catalysts that could break the support. If we can break below 68, we'll call it 68.47 with some strength. Let's say we hit 68.40. I would like to see ES head towards that 68.10 from earlier last week's low. I'm sorry, this week's Tuesday, just a few days ago. If we
68.10,
don't,
yeah.
yeah, if we don't, we could very easily see the range that we have been holding since Wednesday. Wednesday, this held as a low. Thursday, it held as a low. Today's Friday. We are currently holding that as a low. So I would like to see, can we sweep that and reverse, or do we break it with some momentum and look for a retrace and take that retrace to go short?
Yeah, exactly. So it again, it's just like how we try to see how markets are going to digest the data. You also have to look at when markets are at your price level and how they're reacting to it, right? You
Exactly.
shouldn't just take a buy just because it's at a level that you're anticipating a bounce from. Like you should wait for the lower time frames to give you enough information, like how Kevin was mentioning. Either we're going to break this with volume and volatility and momentum because of the bad data that we got, or we're going to see some sort of minor bounce from here, right?
Right.
So it all comes down to, okay, if we see breaks of it, yeah, we can dig lower, and then I can look for buys because I know that the overall structure on U.S. equities is bullish and overall sentiment is bullish. But if we see breaks of it, maybe I'll stay a bit vigilant and I'll look to see where I can really take that higher time frame bias based trade.
Yep, exactly. Perfect, guys. Higher time frame analysis, fundamental analysis, everything has to line up. It's all pieces to the puzzle. And of
It's
course, all
all
that
yeah,
lines up with your strategy, the system you trade, and the risk management you implement.
absolutely. So it literally all comes down to, there's so many moving parts in the financial markets, but the main things are that you have an understanding of economics and macro, because without that, you are on the biggest downside. You're in the 99 percentile of traders who think ignorance is bliss and they have everything figured out. One day there's going to come a time where you get humbled by the market, and then you're going to go on your browser, you're going to go to www.marketedge.ai, and you're going to look at this and be like, oh, this is a platform I should have used, but I'm an absolute idiot, so I didn't use it, and now I blew my account. And now you don't want to be in that position, right? You want to be in the position where we're taking these trades because we understand macroeconomics, where we're able to we're able to call these dollar buys, right? We're able to call this ES retracement down to this level. It's because we understand macro, guys. That's the main thing here, is that we have spent years piecing things together on monetary policy and US economic data. And then we decided to be very generous people and angels and build a platform that can help you do the same. Right? We decided to take the burden off your shoulders and put it on my back and Kevin's back, so we can build the best platform for day traders and retail traders to come to and understand, hey, I trade gold. This is the bias currently because of macro conditions. Amazing. Now I'm going to look for buys. Boom, I look for buys and I profit. I'm not going to look for sells because market's telling me gold is still bullish due to US-Iran tensions escalating. Trump-Iran nuclear ultimatum, U.S. military Middle East setup building, right? And then you take all this information, you're like, oh, I'm actually not supposed to look for sells. Let me look for buys.
There you go.
Sorry, I think I'm cutting off again, so I just turned off my video.
All good.
Somebody said my win rate up by 17% the day I started using market.
That's fire.
Let's go. Big round of applause for that.
Yeah, that's huge, man. That's awesome. That is great. Nilabh's got a great point, guys. If you're not using fundamentals, you're you're setting yourself up with a disadvantage in the market. You're basically saying, I don't really care what's moving behind the scenes. I just want to trade these candles. And that's a disadvantage there because there's more information to it. And by just ignoring it doesn't mean it's not there.
Yeah, exactly. There's always, like, you have to understand that the market is a mechanism, and the mechanism isn't just candles printing. It's millions and billions of data points being digested by market participants every second of the day, right? And that's what collectively moves the markets. The markets are always right? This is what that means. It's the markets are always objective. They are always objectively pricing in the correct price between all market participants. That's why you see ES at 68.58 right now, because that's what global market participants dictate ES's price to be worth, right? Now, when you get catalysts come into it, the price starts to change, the price shifts, and sometimes it shifts very fast and very aggressively because the market participants are acting on it. They're not acting on some random timing that just came into be and they're like, oh, we're going to see buyers jump in now. No, you idiot. It's because data just came out or this headline just came out, right? So it's like, don't ignore the finance part of financial markets.
Yeah, seriously.
Right. So somebody asked, do you guys swing or intraday? I do both. I like to get in on intraday positions at very key higher time frame price points. So I'll give you an example. I took this gold buy last week. I ended up taking profit at highs, right? This was during like the CPI as well during this time. And I also took these gold buys, expecting it to hold it into a swing trade that was going to take me to like 5,200. However, these buys didn't play out, and I actually got taken out at break even on my on partial of my position because market just retraced. So what I go into it with is that I look to take intraday buys and intraday plays off of intraday levels such as this or higher time frame higher time frame areas, and then I'll look to hold a portion of my position in case it just turns into more of a swing trade.
Very good. Awesome, guys. Guys, any other questions, please drop it in the chat. This has been your special edition of Market in the Morning to cover that GDP advance and PCE. Absolutely awesome. We appreciate you all for joining. Make sure you hit that like and subscribe button if you're not already. We do host these Market in the Morning episodes every Tuesday and Thursday. So, guys, thank you so much for being here. Nilabh, thank you for your information and your time.
Of course, man. Anytime, guys. Thank you so much for being
Bro,
here.
it's been a pleasure. All right. Take care, everybody.
Have a good one.